got some great news for SoFi stock investors as the company announced a $2 billion deal with the partner for personal loans. I'm going to elaborate on the details of this deal and why a deal like this is sending SoFi stock price higher by roughly 10% following the announcement. Why does this kind of deal lift the stock price up by this much, and other announcements don't lift the stock price up by this much? I'll go into the details, the financial analysis implications of this deal, and I'm going to share with you the discounted cash flow model valuation that I've done for SoFi stock a little while back, and plug in this new information into that discounted cash flow model and demonstrate why a stock price increases following this kind of news. So I think that's going to be really interesting to see. You're not going to want to miss that because you're going to see that direct connection between a news event and a change in the valuation of the stock price. So let's get into the details and let me share with you all of the reasons why SoFi stock is up following this news. I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. All right, so here's the announcement. October 14th, 2024, SoFi announcing a $2 billion loan platform business agreement for personal loans with funds managed by affiliates of Fortress Investment Group. The agreement will expand SoFi's capabilities in its loan platform business, where the company refers pre-qualified borrowers to loan origination partners, as well as originates loans on behalf of third parties. Now, the big implication about a deal like this is what the CEO says here. Wants to diversify toward less capital intensive and more fee-based sources of revenue, says the CEO. Less capital intensive and more fee-based sources of revenue. And that's the key there. What that does is that lowers risk, because if you're originating these loans and passing them off to a third party, you're not taking the risk of default. If somebody doesn't pay those loans, it's not on you, right? Now, in the past, SoFi has retained a percentage of the loans that it sends to third parties. And I don't know the specific details of how much SoFi keeps in these arrangements where it sells to the third parties. And my hunch is that it's not a meaningful number. Otherwise, they would be reporting that number. They would be required to report that number. But they do keep a small percentage. And otherwise, they do have exposure because if they keep selling third parties loans that don't perform, loans that result in default at a high percentage, then those third parties are going to end their arrangements with SoFi. They're going to stop buying loans from SoFi. So SoFi still has skin in the game. They still need to do their due diligence in creating these loans and in pre-qualifying these borrowers before they sell those loans. So it's not as if they're not interested in making good loans and interested in doing the due diligence. It's just that the risk is now off of their own balance sheet and on somebody else's balance sheet. And SoFi just generates a fee. Let's say the fee is 1%. If they make a $100,000 loan to somebody, they make $1,000 immediately off of that loan because of the fees, and then they sell the loan to somebody else, and whether the borrower defaults or not, that's somebody else's problem at that point in terms of financial repercussions. SoFi just makes that $1,000 fee, and that's a great return on investment because SoFi's not investing all that much capital. It's just taking a fee for its service. That's a much more lucrative business model, a lower risk business model, a higher profit margin business model, a business model that can scale more rapidly because it doesn't get constrained with capital. If you're holding on to all the loans that you're making, eventually you get constrained because you run out of capital to lend. And so you can't grow as quickly. And so that business model is not as scalable. Whereas if you're selling to third party, it's also more scalable, less risky, higher profit margin, etc., etc. I could go on with all of the benefits of this strategy. So that's why that's good news for SoFi stock investors. Now you might say, if this is so great, why doesn't everybody do it? Why doesn't SoFi do it all the time? It's because partners are not as interested in buying those loans. The market for purchasing these loans is not infinite. You can't just continue to make loans and sell it off to third parties because third parties may not be as interested as buying these loans. If you remember, a company called Upstart faced a similar situation where its whole business model was just to originate and sell. And it faced the dilemma because buyers evaporated. It didn't have anyone to buy those loans that it was originating. And so that was the constraint then. So with the announcement, it's good news that SoFi wants to do it. And then it's further good news that it has a buyer for those originated loans, $2 billion worth. So that's what makes it really good because SoFi, of course, SoFi would want to do this. But the difficulty is in finding the buyers for these personal loans, which are, of course, the highest risk loans that you can make is personal loans. There is zero collateral here. If a borrower defaults, there's virtually nothing you can do as a lender to recoup your investment. I mean, you can call and annoy the borrower and try and scare them into paying you back, but otherwise there's limited recourse in these personal loans. That's why they are the riskiest of the loans that lenders can make. So another reason why this lowers SoFi's risk tremendously, and I don't know if you can see all of this small print here. This is from SoFi's latest quarterly financial presentation. If you go to SoFi Investor Relations, you can find this document, and I'm on page 18 here. And you can see SoFi breaks down their segment financials, and they share with you how many loans they originated in the latest quarter and in the latest few years. And in their latest quarter, Q2 2024, SoFi originated $5.3 billion in loans in total, and $4.2 billion of that was personal loans. So roughly 80% of their loan origination is personal loans. That's a risky business to be in. And their 80% of the loans they're originating is in this category. So their risk profile is truly elevated. And that's another reason why an announcement like the one today really lifts the stock price, because when you're already at a very high risk profile, coming down that risk profile has a very positive effect on the stock price. Whereas if a company like McDonald's were to do something to lower its risk, it wouldn't have such a positive impact on the stock because McDonald's is one of the lowest risks investment in the market already. And so it doesn't get much benefit from decreasing risk further. It would get more benefit from doing something that benefits its upside. Whereas SoFi would get more benefit by lowering its risk than doing something that benefits its upside because it already has tremendous upside. But where it's lacking, where the thing is pulling down the valuation is the risk. And I've talked about this all year. Now, let me remind everyone, I've had SoFi stock rated as a buy. I've had SoFi stock rated as a buy, and I've done several valuation methods to conclude that recommendation. And I'll share with you my pricing model, the DCF, and why that's the case in just a little bit. Now, again, what I shared with you earlier was SoFi's originations in the latest quarter, how much loans they made, and the percentage of those loans that were personal loans. Now, what I have here in this slide, which is page 23 from that same presentation I was sharing earlier, SoFi gives you the fair value of all of the loans on its balance sheet. And in total, the fair value of the loans on its balance sheet as of the second quarter of 2024 were $23 billion. And of that total, $15.8 billion were personal loans. Again, a very large percentage of its overall loan portfolio consists of personal loans, the riskiest kinds of loans you can make, especially for SoFi. So that's why this move really brings down the company's risk profile and signals that maybe there are further moves like this in the pipeline, which could reduce its risk profile even further. Now, SoFi has been in the practice of selling a lot of personal loans. They've done this already. This was just another iteration of this strategy, and that's really a good thing to look forward to as a SoFi stock investor. Okay, so let me share with you my discounted cash flow valuation of SoFi stock, which I did on October 7th. You can see the video. I'll link to it at the end of this one as well, or you can search for it on my channel. But one of the things, I'm not going to go through the whole model again here. I'm just going to point to one of the things here, the thing connected to risk, which is beta. Beta measures a company's risk. Beta measures a company's risk by looking at its stock price action compared to the stock price index. So how risky is SoFi stock compared to the index? A beta of 1.71 suggests that for every $1 move in the stock market, whether up or down, there will be a $1.71 move in SoFi stock. So SoFi stock is 71% more risky than the market, or SoFi stock will move by more than 71% of the move in the market. If the market goes up by 1%, SoFi stock will go up by 1.71%. If the market goes down by 1%, SoFi stock will go down by 1.71%. So SoFi stock is a multiple of the market in terms of risk in price action. And so if you look at a move like today, what it does is that it lowers the risk of the business, which should lead to a lower beta eventually over time as the stock price trades on this lower risk profile. It should lower the beta. Now, I want you to pay attention to the beta here, which I have connected to the entire model. The entire model is influenced by this beta, which will result in a change in the intrinsic value per share, which, by the way, when I last calculated SoFi stock's intrinsic value, it came out to $21 per share as of October 7th. That's how much I thought the stock was worth as of October 7th, and it's one of the reasons I've had SoFi stock rated as a buy, because I felt it's undervalued. My calculations suggested it's undervalued. But let's see here what happens. If I lower the beta from 1.71 to, let's say, 1.35, that increases the stock price. Look at that big change to now $27.25 per share. Let me do that again. Let me go back. You see that $21.38. And when I include that lower beta, $27.25. A decrease in its risk by that magnitude will create a big positive impact on the stock price, which you see today. As a result of this announcement, SoFi stock price rises. It wasn't primarily because of the upside of this decision. I think it was primarily because of the lower risk as a result of this decision, potentially decreasing its beta over time and increasing the intrinsic value per share. Because when you're doing a discounted cash flow valuation, the beta is a big input in that discounted cash flow valuation. It goes into the weighted average cost of capital. The higher your beta, the higher your weighted average cost of capital, the more you have to discount all of your future cash flows, and the lower the intrinsic value per share. So I hope this elaborates on why SoFi stock price is up by so much following the announcement today. Hey everyone, if you like watching my videos, then I've added a great complimentary product just for you. I've created a book, I've written a book that's available for sale now that highlights my 6-step investing framework. Even if you don't follow that investing framework, just reading it and knowing how I evaluate stocks will make it a lot more interesting and informative to watch my videos. I've added the link in the description below.